All right, welcome to the webinar, everyone. My name is Jared. I just want to thank you for joining us today. So let me do a quick sound check to make sure everyone can hear all right. Yep, okay, so getting lots of yeses. Looks like a couple no's, but that means, we should be set. So if you can hear, maybe just log out and log back in. But otherwise, looks like we're doing all right. So once again, just want to say thank you for joining me today. So the topic of this is, or what I've named this presentation is Options Trading, Your Next Side Hustle, a Beginner's Guide to Start Trading Options. So really what this is just the fundamentals of options. So if you've traded stock before, maybe even futures, really it's going to be a lot of the lingo and just understanding how options work. We're not really going to get into the strategy side of things, but if you are interested in that kind of thing, stay tuned. I will be doing some stuff on that, coming soon. So without further ado, let's kind of dive into this. So, options of all the financial vehicles, they can be the most daunting. People I think hear options and hear the Greeks and implied volatility and all these things that kind of go into an options contract, can sound somewhat daunting, like I said. Now, unlike, you may think you don't have to be this math whiz, you don't have to, have an MIT degree. I have a high school diploma and, I can trade options. I have been trading options for about 6 years. I've been trading stock for about 10. So what options really give you is leverage. So very much like the future, like a futures contract, instead of just on percent basis with a move of stock, there is the leverage element to this, and so that's why it's so appealing for people who may be trying to grow a small account quickly. Um, Options provide a lot of different things. You can use them as a hedge. A lot of people like to own stock and then sell options if if your stock is moving against you or something like that. With covered calls or cash covered puts. So anyway, next kind of thing, just a normal disclaimer. Any kind of trading, there is risk of loss. So if you're trading, your rent or your mortgage, you probably should, and if maybe instead of probably, you should definitely not be doing something like that. When trading, you should never be trading money that you can't afford to lose. So definitely read through this, but it's something with the right mindset, the right money management, and limiting yourself with not putting all your money into one trade or something like that. You can trade options without risking the farm. So let's dive in. So options contracts. So unlike stock, options are a derivative product. So it's a derivative of a stock, an ETF, or futures. So an options contract is a derivative product of something like stock, ETF, or even futures, like I just said. An options contract gives you leverage similar to a futures contract, but unlike futures, there are many ways to trade options with fixed risk. So kind of as I mentioned, you can do strategies where you have the leverage as you would with futures, but there's not this unlimited risk. A single options contract represents a control of 100 shares at the fraction of the cost. So let's just take a look at kind of what that means. So, for example, let's take a look at buying 100 shares of Apple stock at the price of $222.11. So when I was putting this together, that's what it was trading at. So buying 100 shares of Apple stock is basically $22,211, pretty easy math. But buying one at the money options contract, so at that price, it would be $980. So basically you can see that for a fraction of the money, you're controlling the same amount of stock. Now, let's go and look at the option building blocks. So these are calls and puts. So if you're doing something like a spread, an iron condor, or butterfly, and if you don't know what these things are, those are basically just ways of structuring trades with options contracts. Now the fundamental pieces of these are calls and puts. So a call option is a financial contract between a buyer and a seller, giving the buyer the right or the option to buy the underlying asset at the agreed upon price, which is called the strike price. We'll get into that here in a minute, within a specified time. The buyer of the call option benefits when the upward movement in price of the underlying asset. A call option is a fixed risk strategy, meaning the cost of the option at the time of purchase is the max risk to the buyer. So I touched on that just a second ago. Basically what that means is if you're buying a call option, you're hoping that whatever it is, so if you're buying Apple call options, you'd be hoping that over whatever period of time, so with an options contract has varying amounts of time. You may be buying weeklies because you only have, a couple of days, or you might be buying 30 to 60 days out, whatever it is. And so basically, if you're buying calls, you're looking for the stock to move up. And the way I sort of learned this, just an easy way to think about this is, if you're getting a phone call, you're going to pick the phone up, so upward momentum. So this is a bullish type of position if you're buying calls. Now, kind of in the inverse, if you were selling calls, I don't want to confuse people who may be new to that kind of concept, but if you're selling calls, that's obviously, or that would be a bearish type play. Now, this is an option chain here, so we'll get more into what the option chain is in a little bit. But you can see over here on the left with the yellow arrow and now the pink arrow, you see these are our calls. And at the money would be basically right now. So at the time, let's see, Apple was trading at 219.31. So the at the money would basically be like the 220 strike. So the at the money would be these here. And, for 700, actually, so about 750 is what, you could get an at the money Apple contract. So those are 27 days out. So we're going to talk about the opposite side of that now with put options. A put option is a financial contract between a buyer and seller, just like the call option, and basically, really without kind of reading you the definition, it's basically the opposite of a call. So a put option takes advantage of downward movement, so it's a bearish type play, as you can see with the nice little wooden bear we have here. Basically, with in the case of Apple, once again, if you're buying put options, you'd be looking for Apple to move lower. Now, very much like the call options, you'll see over here on the right-hand side of the option chain, you'll have your puts, and here are your different put options. So these are the different strikes, so we'll get more into that in just a second here. But next, we want to talk about options volatility. So if you've never heard of this before, this is incredibly important to understand with options. So when I've started trading options, I kind of understood the leverage of it. I didn't really fully understand volatility, and I paid the price, for learning kind of the hard way. Options volatility is incredibly important to understand, especially around times like earnings, where the cost of your options is going to be inflated due to earnings. Now, I'll touch on that here and more in just a moment. So implied volatility, or sometimes referred to as just IV, or just volatility, or vol for short, is a representation of how volatile the underlying asset will be before expiration. Implied volatility can be a good measure if options are under or overvalued. With a high implied volatility, this would imply a large move from the underlying asset, but provides no indication of direction. So, just in the name, it's implying that whatever the underlying asset is will be, how volatile. So it's basically a measurement of how volatile they think the underlying asset will be. So I touched on this just a second ago with earnings. So the closer you get to earnings, what you typically see, and basically every time, is implied volatility, continues to go up the closer you get to earnings. So if this is, we'll use Apple again as the example, and if Apple is supposed to report earnings, I'm trying to remember when they reported, just recently. Basically, the closer you get to that expiration of the contract, the more the option contracts are basically going to be overpriced. So typically, in an earnings type situation, people who really don't know what they're doing, if they're buying options, they're typically going to be significantly overpriced, because when earnings happens, volatility completely drops, because there is not this idea basically around earnings. Stocks can be super volatile, where they move up and down by double-digit percentages sometimes, and that's just a well-known thing. So there is this implied volatility is going to be higher. I know it's sort of a funky thing to kind of wrap your head around, but really it's just a measurement of saying, okay, well, normally, this stock is trading at this, and so we'll get into that actually. So I'm kind of getting ahead of myself here, but and I touched on this kind of a little bit. Implied volatility can be a great indicator, whether you should be buying or selling options. So I mentioned that at the beginning of the presentation, is that you can buy a call or sell a call, or buy a put or sell a put, and that really determines, or implied volatility can determine what you should be doing with options. So if you're looking at the implied volatility and it's much higher than normal, that's basically telling you that the options are going to be somewhat overpriced, and it's a better environment to sell options, where when you're selling an option, you're getting a credit for selling it, being the option writer. So, and here's basically in the option chain, you can see here with that yellow arrow once again, for those particular contract weeks. So, at the time of putting this together, you can see the weekly contracts at that time, the implied volatility was 31%. The following week it was up, 9%, and just a little bit below that. Now, depending on what historically it's at, that may be high or low, but you can see just for the fact that it went up by 9 points, there's something going on that week, and I believe that was, I can't remember when they reported earnings, to be honest. It's been kind of crazy the last few weeks. But either way, this is basically saying that, okay, we're expecting something bigger to happen this week. And right here is sort of the expected move in terms of points. So 219, so they're expecting 7 points in those 6 days on that particular contract. And like I said, once again, in something like this, so the November 18 contracts, or excuse me, the November 2nd contracts, you'd be looking at selling options with something like this because the IV is so much higher. So you're basically saying that the options are sort of overpriced because they're expecting a bigger than normal move. So the other side of this is historical volatility. So historical volatility is a representation of how far whatever underlying asset deviates from its mean value or moving average. So you can basically say, okay, I want to look at a 21 period historical volatility, and it'll basically show you kind of that average over that period what the volatility is for that underlying asset. So if you set that for 21 days, that's basically 5 trading, or basically a little more than 4 trading sessions, and what you'd be looking at in that case is an average of that. And 21 is something I'll look at sometimes at 34, and those are Fibonacci numbers. A lot of people look at like a 20 period average, but basically what you would do in this situation, or what I like to do in this situation, is look at historical against implied. So historical is saying, okay, over the last 21 periods, this is what the volatility has been. In the case where your IV is low, for example, that could be an opportunity rather, to buy options. Now, buying options is something that if you're new to trading options, you really probably shouldn't do. Depending on what you're doing, if it's a butterfly, you're going to be buying butterflies, but just buying calls or puts outright, it really, there's a lot of factors that going into that, with things like theta decay, which we'll get into just briefly here in just a moment, but other things like just timing the move itself, because even if you're right to an extent, where you get some upward movement, it really depends on, once again, the implied volatility, where the options overpriced when you bought them, and things like that. So looking at IV before making a decision to buy or sell options is incredibly important. And once again, so if you're looking at historical volatility, it's something like, just for easy math, say it's 10 normally, that's really low. But if they're currently 20% implied volatility, then the options are incredibly overpriced at the moment, or they're expecting a bigger than average move. And if you have some bias on directions, then you basically would sell options to take advantage of the high implied volatility. So does that all make sense? I know I'm kind of going a little fast through this, but really want to just kind of get through this stuff. There's not, once again, I want to reiterate that this shouldn't be daunting. I think it's something that people get so caught up on the, tons of details that you can really get into with options. But if you look at this from just a very simplistic way, there are some key things to kind of follow. And I am a big proponent of the more you learn, the more you earn. So there's just a ton to learn about options, but I'm trying to give you sort of the nuts and bolts of what's important to really kind of, dive in and get started. So hopefully this is all kind of making sense, seeing lots of yeses. And we will save some time at the end, to answer some questions. But anyway, so let's go ahead and get to the next slide here. So the option chain, I've shown this a few times, and we'll kind of go through different kind of areas of this and things to kind of pay attention to within the option chain, and just the basic understanding of how it works. So once again, you've seen this image a few times now. So this is the option chain. So let's kind of dive into the different elements of this and what you should sort of focus on. So strike price. So strike price is the price that the underlying asset can be purchased at if the option contract is exercised before expiration. That's sort of a mouthful, but strike price is determined at the time of purchase or when the option contract is written. So we'll go and take a look at the chain itself again here, and I'll kind of just walk through kind of what that means. Now, in our example again, we're looking at Apple. So at the time of this screenshot, Apple was trading at 219.31, and if I were wanting to, say, buy options, so I'd be looking at the left side over here with all the calls. Well, actually, so let me restate that. So if I were wanting to do a just straight up purchase of an option, a call or a put, but I was wanting to do something to the upside, I would be looking at the call side of things. And typically if you're buying options, just a quick crash course on buying options just outright, more times than not, you're wanting to buy in the money. So in the money is basically anything that is already below the current price for a call. So currently, like I said, price is $219.31. So anything below $219.31 would be in the money. So basically, price is already higher, and those options are going to have more intrinsic value, which we'll kind of touch on more. It's very implied what that is, but so this is the option chain, and hopefully that makes sense with strike prices. So basically what it's saying is you're buying a contract that at the time, you'd be buying the 205s hypothetically, so that would be roughly like a delta 70 or delta 60. And those options already have intrinsic value because price is already 4 points ahead of that, or excuse me, 14 points ahead of that. Hopefully that makes sense. All right. So next, and I kind of mentioned this already, at the money. An at the money contract is when the strike price is at the current spot price of the underlying asset. So in the example I just gave, Apple was trading at 219, I believe, what was it, 219.31? Yeah, there we go. And so basically you would be buying the strike closest to that, so 220 in this case. So the at the money option will have a delta around 50. This rating indicates that there is basically a 50% chance that the strike will end up in the money. Basically also what delta is sort of showing you, we're not really going to deep into the Greeks in this, but basically delta is a representation of, for each 1 point that the underlying asset moves, it's going to move half a point. Or the value of the option, excuse me, will kind of increase by 0.5%. So an at the money option will have no intrinsic value, so only extrinsic value. So getting back to implied volatility, when an option, or when you're looking at buying or selling options, if you're looking at an at the money option and there's not many days left for expiration, but the options are super expensive still, that's probably a good opportunity to sell options because there's so much extrinsic, they're so overpriced basically, and there's no inherent or intrinsic value. So let's look at this. So, like I just mentioned in the example of Apple, you have the 219.31, which is our current price. So the closest to that would be the 220. So those are the at the money strike in the call and the at the money on the put side as well. Does this all make sense? I mean, I think that's pretty self-explanatory. And you'll see kind of next there's a few other terms that kind of go along with this. So, I mentioned just a moment ago the delta. So the way you can see that here in the option chain is up at the top, and this is Think or Swim. So if you, if you're kind of wondering what platform, this is the platform I use. So right here, this is kind of a drop-down menu where you can change between things like open interest and then the Greeks. So if you change it to this layout, you'll get the Greeks here. And like I said, the at the money strike is going to be right around a 50 delta. And delta is obviously right here. The next slide will be once again showing you at the top you can change the layout structure, and this will just show you kind of the intrinsic and extrinsic value of the option. So like I mentioned, the at the money strike is not going to have any intrinsic value, but as I mentioned just a moment ago, if you're buying options, whether that's a call or a put, typically more times than not, you want to be buying in the money if you're just buying straight out, an option or excuse me, a call or a put. So you can see right here, the first in the money option, excuse me, in the money strike has $1.51 of intrinsic value, but it has a ton of extrinsic value. So, $6.11. So the next term is going to be in the money. So we've touched on this already a little bit, so it should be pretty easy to kind of grasp this at this point. So an in the money option, it means that the contract was closed or exercised, it would be profitable at that time. And in the money option will have a delta of above 50. For example, a delta of 70 would be in the money. It would mean there was a 70% chance the option would be profitable at expiration. And in the money option has intrinsic value. So unlike the at the money, these options are already below, in the case of a call, below the existing price. And the opposite for a put. So if you're buying in the money put options, in the case with Apple at 219.31, you would be buying something like a 225 put, and that would be in the money. So just taking a look at that. So basically in Thinkorswim, you can see in the money is always going to be the highlighted area on both the call and the put side of things. Does this all make sense? Yeah, okay, good. Great. All right. Yeah, I mean, it's really, like I said, I mean, you shouldn't be overwhelmed by this stuff. It's just kind of getting past the idea that this stuff is supposed to be super complicated. And I think once you kind of just get in and look, it's really not that bad. I mean, it's just really like anything. You kind of have to learn the lingo, and from there, it just gets a lot easier. And once again, just kind of showing you, delta, so a delta 55, so that's barely in the money, and really going up from there, you see the delta increases. So, a 91 delta is basically saying that with, every one move, you're basically getting 91 cents. So nearly a 1-to-1. All right, and so basically the opposite of this, out of the money. An options contract that is out of the money means that if the contract was closed or exercised, it would not be profitable. Out of the money options will have a delta below 50. For example, a delta 40 would be out of the money. So very much, I think at this point going through all three, you should sort of understand how these all work. And we'll kind of look at this real quick in the option chain, but very similar to before. It's really just anything that is not in the shaded area. So once again, with our 219.31 example, if you're buying out of the money options, so for a call, you'd be buying anything below 219.31, or excuse me, above 219.31. So we have not yet got above 220. That's the at the money. So 222.50, that is an out of the money option. I know it's a little confusing because technically the 220 is out of the money as well, but it's basically your middle line, so it's referred to as at the money. So does that all make sense? And you can see on the put side, it would be the opposite. So price is not yet below these, so these would be out of the money. So your 215, that's your first out of the money strike. Very, like I said, I think once you kind of get in the understanding of what you're talking about here, it kind of all falls into place. Yeah, I'm glad this is all making sense. Great, glad to hear it. All right, so once again, just kind of a final representation of this. You can see your delta decreases the further out of the money you are. And let's go ahead and get into options premium. So premium is basically when you're determining whether you're buying or selling options, very much like your implied volatility. It's talking about are your options overvalued? What is the cost of them and what is the value of them? So kind of intrinsic, extrinsic value. So options premium is the extrinsic value in an options contract. With options that are out of the money, there is no intrinsic value. So the option is entirely made up of premium. So as I mentioned before, when you have implied volatility much higher than historical volatility, there's a lot more premium in those options, and that's how you'll kind of hear people refer to this. And so it's a much better opportunity to sell options. So when selling options or being the options writer, the premium acts as immediate income for writing the option. Options with higher implied volatility will have much more premium, as you'll see right before earnings. With larger expected moves come more premium and more expensive options. I think that we've touched on a lot of this already, but it's just kind of driving home that idea again that, it's not always a good idea to kind of swing for the fence with like buying a call or buying a put, because with those types of things, there is, a higher potential reward for being right if you get the direction right. But more times than not, selling options is really the name of the game, and you're selling premium. So we looked at these a little bit earlier. So we're back in the option chain once again, is where you'll spend a lot of your time when you're looking at trading options. So we changed our layout here to intrinsic extrinsic position, and you'll see here basically the intrinsic value. So green basically showing the true value of kind of what the contract's worth, and extrinsic. So this is the premium you're paying to the writer. So whoever's selling option is the option writer, because when you're trading, there's always, someone buying and someone selling. That's how a market is made. Alright, so an important concept to understand with options is time decay. I've touched on this, I think, just briefly. I kind of talked about this, but let's get into kind of what this means. So time decay with options, or commonly referred to as theta decay, can either be working for you or against you based on whether you're the options seller or the options buyer. When buying options, time is not your friend. The closer you are to expiration, the more rapidly the premium in your options begin to decay. This is represented by one of the most important Greeks, theta. When selling options, time decay is working in your favor, as the options you sold are losing value. So basically, like I said, it's kind of weird how this all works out. When you go to start trading options, there's different levels of access, so to speak. The types of positions you can trade. Selling options naked, things like that. Spreads. But when you first open an account, most times than not, you're going to have options level 1, and that gives you the ability to buy calls and buy puts, where to me it's sort of backwards from what it should be, because when you're buying calls and puts, it's very much a time-based thing where, as I mentioned, when you're buying, theta decay comes into play. So that premium starts eroding on those options. So the value, so when you're buying something that's out of the money, it's nothing but premium, because you're not actually above where or below the price should be, or currently is rather. So when you're buying options, time is working against you. When you're selling options, time is working for you, because every day that goes by and that price has not significantly moved, in the buyer's favor, those options are losing value. And so here's a really great representation of options, the closer you get to expiration. This is a very common image you'll see when talking about options. So you can see here at the top, time decay from 120 to 90. And basically, the closer you get to expiration, the more that decay starts really kicking in. So you can see here at the 30-day mark, this is where the curve really increases the most. And so I like to do strategies with options, and we're not really going to get into the strategy thing, but I like to sell options generally with like less than 30 days. So anywhere between 30 and like 15, I think, is kind of the sweet spot for me. But this is a really important just kind of image to kind of set in your head, is that when you're buying options, you have to be right, and generally by a decent margin, pretty quickly, because the longer you wait for those options, or the closer you get to expiration, the more that decay starts kicking in. So that's, that one seems to be kind of a weird thing for people to understand. So does that all make sense to everybody? So theta decay is not good for buying. Yeah, so exactly. So, theta is something to be very cognizant of when buying options, because the closer you are to expiration, the more those options will decay. So if price is just chopping sideways, so, that 219 area, so if you're just chopping around 220, 218, price is just chopping through there, those options are decaying with every day that passes. Alright, so we've basically covered the majority of the nuts and bolts of what I kind of consider the very beginner's level stuff for options. So let's kind of put this all together with an example, and we will we'll kind of go through one of these with some bias in terms of direction. Alright, so sticking with Apple here, that's a favorite of mine. I actually used to work for Apple, but no, not relevant necessarily at this point. But anyway, so here is a chart of Apple. This is a daily chart, and let's say that we have a negative bias, and you can tell that, this was done, I put this together just a week or so ago, so, we've seen some movement actually to the downside in Apple. So, it was looking like I was actually right based on, the example here. So anyway, so you can see we're looking at put options, and we're going to keep this basic, like I said, just a buying a put option. So the idea is that we're wanting to take advantage of downward movement in Apple, and so we'd be looking at put options. So if I was just straight up buying puts, typically what I'm going to look at is buying, deep in the money options, because you're getting more of that move the deeper in the money you buy. So if you're buying out of the money options, you need a significant move quickly, to make money on those options. So it's really rarely a good idea to buy out of the money options. So once again, you can see these are the options I'll be looking at. And I typically look to buy a delta 70 option, so that would be these options here. And here's an important concept to kind of get, I think sell in your head here, or sell yourself on rather, is like honey is sort of the way I learned this. Is you can go to the store and you can buy the bear honey that's riddled with artificial sweeteners and sugar and additives and all these things like that, but it only costs $2.50. Now over here on the right, you may have something that's like organic, all natural bee honey, straight from the hive essentially, but that may cost 3 times as much. Now if we're talking about value in terms of, the health benefits, the little bear, although it's cute, is terrible for you. It's got all this bad stuff in it, but it's a third of the cost, where, the $6 honey over here, like I just said, is 3 times more expensive, but it's got all these, good benefits for you. It's natural energy, all this stuff like that. So it's important to think of options that way. Is okay, look at these options here. These are, out of the money, $4.80. But if we go, 4 strikes in the money, or I guess 3 strikes in the money, we're looking at, a delta 60. But this option at least has intrinsic value where these do not. So, I hope that kind of analogy, sets with some of you, because that's really key to understand with options, is that more times than not, buying options is something that takes really good timing, and I think it's not something new people should really get into if you're just getting started with options. More times than not, you should be doing spreads with options if you're getting, just getting started, especially with a much smaller account. But anyway, so that's really it I have, guys. I hope this was helpful. I know we kind of blasted through that in just about 30 minutes. But really, I don't think that, for people that have been trading for any length of time, I think some of these things should be relatively easy to understand. Understanding that you're buying a derivative product, and so there are sort of the give and take where you get the leverage, but there's things like time decay that goes into play, if you're buying options. But I really want to drive this home, and I know we're not getting into the strategies themselves, but more times than not, you really should be selling options, because you can take advantage of, if you're right in your directional bias. But if the stock or the underlying, whatever it is, the ETF, moves sideways, as long as it's above the strike that you sold, you can still make money. So that's the beauty with selling options, is if you're buying, you have to be right quickly, and sometimes within the move has to be somewhat decent for you to actually make money when buying options. Now with selling, like I said, there's you can actually make money if the stock just moves sideways. So anyway, guys, I really hope this was helpful. I will answer some questions here in just a second, but I wanted to show you something real quick, and then we'll kind of get into the questions. So if you enjoyed this, if you like the sound of my voice, and would like to follow along with kind of what I'm doing, for completely free, there's not going to be any kind of charge for this, is basically just my newsletter. So if you go to SelfLiquid.com, this is right on the home page. I'll share videos with you, any kind of important news, my trade analysis, alerts, and really just a lot more. So I'm planning on kind of just starting this off as somewhat of just a trading blog. Like I said, I've been trading actively for about 10 years now. I've been trading options for about 6. I really enjoy doing this. I love talking to people about this. Every single day I have got, Skype open, I've got Discord open, chatting with people on iMessage, whatever it is. I'm just kind of willing to have multiple chat things just so I can talk to all my trading friends. And, I'm basically trying to build a community of people that enjoy trading as well. If you're an asshole, I'm sorry, and hopefully that doesn't offend you. You probably shouldn't be listening to me. I just want to hang out with like-minded people, and, so I'm basically just kind of set up a community here. And if you'd like to join, like I said, completely free, just go to selfliquid.com and enter your email address, and you'll start receiving my videos. So I've been doing those on Mondays, Wednesdays, and Fridays. And if I find a trade that I want to share, I'll send that out as an alert to you all as well. So once again, I really hope this was enjoyable for you, and I hope you've learned something. Feel free to leave a comment on the video here below. Ask questions, and yeah, once again, we'll go and dive into the questions. So for anyone that needs to go, I appreciate you sticking with us tonight, and you have a good rest of your day. All right, so let's get into the questions.